In the US right now, the gold trade is, I don't necessarily call it moribund, but slower, but not so in the Middle East, not so in India, not so in Turkey, not so in Asia. They're buying because they see what the dollar is doing, and they're on the receiving end of that. It's not doing any good for them. They don't trust their local currencies. What do? They buy gold. So gold is being bought massively in certain parts of the world. People are going to get richer by holding gold, perhaps, but they're going to get poorer by holding dollars, that's for sure.
In the perspective of Keith Weiner from Monetary Metals, the recommendation for investors is to turn to gold as a safeguard for their wealth. He asserts that while the prospect of getting richer by holding gold is a possibility, the certainty lies in the erosion of wealth by holding dollars, gold holding its ground and marking a second consecutive weekly rise. Analysts' speculations about the U.S. Federal Reserve potentially concluding interest rate hikes have contributed to a decline in the dollar, further enhancing the appeal of gold. Weiner notes that the gold market has shown resilience, maintaining a trading range between $1,900 and $2,000. Despite a perception of a slower gold trade in the U.S., he highlights increased activity in other parts of the world, signaling a global interest in gold as a store of value. In the third quarter, gold demand exceeded the 5-year average by 8%. Central bank buying, while slightly below the exceptional levels seen in the same quarter of the previous year, remains robust. Year to date, central bank demand has surged 14% compared to the same period last year, reaching a record 800 tons. Weiner identifies two key factors influencing the gold market: forced selling, likely driven by financial pressures, and increased buying due to concerns about central bank actions. Join us as we delve into insights shared by Keith Weiner. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
At a very simple level, the prices, by definition, that's a balance of sellers and buyers, right? So if more people suddenly sell with urgency, then they keep pushing the bid down, and if more buyers are buying with urgency, then push the bid up. But the fact that somebody famous, let's say a central bank bought, doesn't really tell you which of those two is happening. Is it that there's, I call it the famous buyer fallacy.
Oh yeah, we talked about this, yeah.
Right, so the central bank of whatever country bought. Okay, did they bid it up? Or was there, 100,000 anonymous, not famous sellers, and they happen to be the buyer that put in the bid, to get that gold? I think right now you have a combination of two enormous forces, and it's been this way for a couple of years, which is there's a lot of people that are forced sellers. They don't necessarily want to sell. Like you talk to a lot of the bullion dealers here, and people who bought gold from them maybe earlier this year, or last year, or the year before, are now coming back to sell it. And some of them, maybe they're selling because they think the price went up and they got their gain and that's it. I don't think most people buy gold, gold coin thinking they're going to sell it if the price goes up $100. I think a lot of them are under stress financially, and gold is the liquid, which is the reason why they bought it. It's a liquid asset that you can sell when you need to sell something. So I think there's forced selling. And at the same time, there are people that are buying because, hello, the madness of central banks. Do you really want to be a creditor to the Fed and own dollars, or creditor to the Treasury and own Treasury bonds? It's absolutely nuts. And it's nuts worldwide. The US is not unique in any way in having gone mad. All the countries have. So in the US right now, the gold trade is, I don't necessarily call it moribund, but slower, but not so in the Middle East, not so in India, not so in Turkey, not so in Asia. They're buying because they see what the dollar is doing, and they're on the receiving end of that. It's not doing any good for them. They don't trust their local currencies. What do? They buy gold. So gold is being bought massively in certain parts of the world. Gold is being liquidated, in many cases involuntarily, and then you see a gold price that doesn't seem to want to get out of a range of 1900 something to 2000 something. But I think we're not in the bear market of 2012 to 2018. We're in a bull market, maybe with volatility and uncertainty and a lot of sideways motion. But I think we're in a buy the dips market, which is not what we were in 2012 to 2018. That was a sell the blips market. As gold becomes more and more of a monetary system asset, people are going to want to own it. And so extrapolate from there. I wouldn't care to make a price prediction on it. But as you go to a gold standard, price of gold being money, the dollar being some failing, dying currency that's fading away, the price of money in terms of failing paper becomes less and less relevant. So it's more, are you going to get rich buying gold? I mean, you never did. Rich people own gold, but they didn't get rich because they bought gold. They bought the gold to preserve the rich that they already had. If the paper currency is failing, so imagine you're on an elevator that's about to drop from the 27th floor into the basement and crash, and you step off the elevator onto the 26th floor. Are you skyrocketing while you're standing on the floor? No, you're not. But you avoided crashing into the basement and perhaps dying in the accident. That's what gold always did. People are going to get richer by holding gold, perhaps, but they're going to get poorer by holding dollars, that's for sure. So that's really why I think people should be owning gold. If you want to speculate on something that's going to skyrocket, that's not really what gold does anyway.
The choice of gold as the foundation for a new currency system is strategic, aiming to capitalize on gold's inherent characteristics to ensure stability in the currency's value. This decision suggests a deliberate move towards a more reliable and universally accepted medium of exchange. The anticipation of Russia assuming the rotating BRICS presidency in 2024 has sparked speculation about the potential acceleration of a new BRICS currency issuance in the coming year. Weiner's perspective aligns with the idea that rather than creating an entirely new currency, nations could settle trade imbalances by exchanging goods and services, with gold being used to reconcile any differences in value. This approach emphasizes the practicality of leveraging gold in international trade, even if official sectors may initially be hesitant to fully adopt it. The argument is that, over time, the necessity and efficiency of gold in settling international trade transactions could organically lead to the development of a gold-based system. Let's get back to the interview.
What I think they're going to do is not try to make some sort of new currency, which I don't think they can agree on that anyway. Gold is the one thing that doesn't require agreement. If I put gold on the table, anybody is happy to deliver oil, wheat, electronics, you name it. No questions, no further discussion is necessary, and nobody has to trust anybody because gold is gold. So I think as those countries try to do bilateral trade, so Russia is selling oil to India, and at first it was, oh yeah, all for one, one for all, we'll do trade in their own currencies. So India was paying Russia in rupees, and probably stickering up their sleeve. Russia announced, actually said to the world, that we're not going to accept rupees anymore because we've stacked up a pile of useless, was their word, rupees. So they were thwapping their trade partner, verbally with that. But India has capital controls. Rupees are not useful outside of India. Nobody wants them. China has capital controls. Yuan are not useful outside of China. Russia has capital controls. Of the four, Brazil is the only one that doesn't. It's an open capital market. So none of them want their own currencies. What I think they're going to do is they're going to pay in gold, to settle the differences. So country A sends something to country B sends something to country A, but this was slightly more valuable, so the difference is settled in gold. And I think at first, obviously, they're going to put bricks of gold on an airplane and fly it over, because that's what you're going to do, right? That's how the gold market works. It's a physical delivery kind of system. But I think fairly quickly, maybe that takes a few years, maybe that's faster, everyone realizes, man, what a waste. What if we all had a jurisdiction that we could agree on, that we could all have gold in the same jurisdiction, even the same vault within that jurisdiction, and now if I need to pay you 1,000 ounces of gold, I just send an order to transfer within the vault to you. So I'm Russia, you're India, or whatever. So I think that's what happens next. And then the question is, what's the jurisdiction? I think the answer to that is Dubai. Dubai is neutral. It's not Switzerland. I mean, Switzerland took the side of the United States and sanctions against Russia. So Russia's not gonna go for Switzerland, and Switzerland wouldn't accept Russian gold at this point. I think it's Dubai. I think will be that jurisdiction. I think the gold will come there. It's already coming there anyway for other reasons. And I think you begin to see organically, feature by feature, evolving, not because some fancy economist, including myself, has a theory that says this is how it's supposed to work, but just because everyone has a need to accomplish a certain goal in the transactions they're trying to do, and that's going to be accomplished by building a gold standard from the ground up. So they're going to have the gold there, they're going to be trading warehouse receipts rather than actual bricks, flying on airplanes. From there, finance is going to come up. From there, earning a return is going to come up. That's what monetary metals do. We pay yield on gold. So we intend to be there and within the limits of the law. Obviously, we can't deal with Russia as a counterparty, but to facilitate that for finance and pay a yield on it and so on. And I think that's going to evolve because no paper currency can replace the dollar, not even remotely close. A dollhouse can't replace a skyscraper, not even remotely close. Gold is the one thing that can, and nobody really wants it to at the official sector level, but they're going to end up using gold because nothing else works. It's the old Winston Churchill quote during World War II. He said, "God bless America." And there's a very backhanded compliment because he said, "God bless America because after they've tried everything else, they'll do the right thing." God bless the world because after they've tried everything else, they'll go to gold.
While there is a nucleus of committed regular buyers, the range of countries whose central banks have added to their reserves over recent quarters is broad-based. Will the current trends of people wanting gold and central banks buying it keep making gold a safe and important thing for trade and money in the future? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.